Welcome to another edition of Around the Table with Stacy Smith. February may be the shortest month of the year, but it is long on volatility, at least for this year. With one trading day left as we record this, from the high of the month to the low of the month, the swings have been absolutely dramatic. For the Dow, it was a swing of 10% in the month of February. The S&P 500, 10.5%. And for the NASDAQ, a stunning 13% swing from the high to the low. There are many reasons, of course, for the volatility, but two seem to stand out, at least to me. Decades high inflation, which might trigger a bigger than anticipated hike in interest rates by the Fed, and Russia's war on Ukraine and the impact that it could have on the economy. For an investor, it can be unnerving to see the market swing back and forth like this so violently, and then also wait for the Fed to act, and then also wait to see what's going to happen as far as that war in Europe. So that, I think, sets the stage for a discussion of the economy and investing by our outstanding group of advisors and strategists. I would like you to meet CARRIE Coghill. CARRIE is the president and CEO of Coghill Investment Strategies, headquartered here in Pittsburgh. She is recognized as one of the nation's leading voices on financial advising. As we go around the table, right next to CARRIE, we find Frank RUSCETTI. Frank has been advising clients for 50 years, and Frank helped to establish Harvest Financial, where he's the executive chairman. Across the table, or above Frank, maybe of the table, we find Kim FORREST. Kim is the chief investment officer and the founder of Bokeh Capital Partners. Kim has a dual background in both finance and software engineering, and you may have seen Kim in her many appearances on CNBC, Fox Business, and also on Bloomberg. And the last panelists at the table, on my immediate, as you look at this, on my, what is that, on my left? No, my right. Yeah, my right. There we go. Our last panelist here is Bob Fergasso, who's a name familiar to a lot of people in Pittsburgh. Bob has been in the investment business now very close to 50 years. Sometime in the month of March, he's going to reach that 50-year plateau. He's also the chairman, the chief executive officer of Fergasso Financial Advisors. I want to thank all of you once again for joining us for Around the Table with Stacy Smith. I hope we have a good discussion today. Now, Bob and Frank, I'm going to start with you. As you have both mentioned, you have been in the investing business just a little bit longer than CARRIE and Kim. And other than 2020, with the onset of the pandemic, have either of you seen this kind of market before? And if so, how does one deal with it?
All right. Yes, I have seen it during the entirety of the 50 years, and I think Frank will say the same thing. This downturn is for a short period of time. There have been many, many downturns that have been for a full year or more than a year. During my time in the business, it started out with 73 through 1975, where the market was down back to back 2 years, both 10 and 20%. That was pretty substantial. It went on through the 70s, where the later 70s, it was down 10% for a year. In 1982 to 83, also down 10% for the full year. That's very different than going down 10% and then recovering. That felt pretty devastating. The dot-com bubble burst of 2000, and then the 9/11 attack of 2001 gave us 3 years of downturns in the 10 to 20% range. That rivals the downturn of the crash of 29 in the early 30s. The world financial markets have had this kind of a cataclysmic drop, seemingly, but it's always recovered. We've dealt with all of that with proper asset allocation and a very close scrutiny of the securities that have gone into the portfolio. We cannot time our way in and out of those downturns. That's true today too, but we can manage our portfolios through them.
All right, Frank.
As Bob chronicles, the market has corrections all the time, sometimes for reasons that can't even be explained until well after they're over. Regarding this military action, this probably is most like, in the last 30 years at least, the Gulf War, which led to a recession that we had in this country. But in that one, we were actively involved with our military and our guns, and it looks, at least at this point in time, where that's not going to be the case here. Hopefully that will remain to be true. This event is pretty interesting, because I don't, in my memory, remember anyone talking about using nuclear weapons. And that is a pretty thing that pretty much concerns me. And I hope this fella is not as crazy as he seems. So the market, on the other hand, is really unimpressed by wars generally. This one is going to probably keep interest rates from rising as much as we thought a few days ago, and probably keep inflation around a little longer than we thought, because of the disruptions that we're going to have in both grains, which Ukraine and Russia are large producers of, and energy, which Russia, as we all know, is a large producer of. And possibly we're going to shut that supply off.
All right, good. Carrie and Kim, what are you telling your clients right now?
Well, I think the most important thing that clients need to understand and really take a step back with is to understand what the market represents. It represents a lot of companies that hopefully have positive cash flows and produce goods and services. So when we're looking at any conflict going on around the world, to take a step back and to say, okay, well, I'm still going to be using my iPhone. I'm still going to be buying my drugs. I'm still going to, do things. How much of this is really going to impact those companies? And that's what we're trying to dig into every day. So for clients, understanding their personal goals. When an investor puts money into the market, the most important question that they need to understand is, when do they need this money? Do they have the time to ride out normal economic cycles? And although these abnormal activities affect the economy, we're still looking at a normal economic cycle. Is this war going to ultimately push us into recession or not? So knowing the time frame, and the most important thing for an investor right now, if they're properly allocated, is to not be going to cash. If you're properly allocated and you go to cash, you miss the opportunity for recovery. When you look at the biggest up days in the market, they generally follow the biggest down days, and you can't time that.
Kim, it wasn't that long ago, you also said, don't go to cash.
Right. Well, I think everybody should pay attention to that. Pretty much everyone on this broadcast has always said, don't go to cash. So do us a favor, don't go to cash. And why is that? It's because you're locking in probably losses at the moment where you are most afraid. And I have to tell you, a little bit of benign neglect is probably what is called for in most of the people who are what we call retail investors, meaning you may not be having a professional run your portfolio of individual stocks. And so what happens is you don't maybe have context for what's happening around you. And people like Bob and Frank, who have been in this business for, I think we could say forever, and not like ruffle any feathers.
They were back trading rocks way back then.
People like Carrie and I, who have a little
forever to a kid like you.
well, I'm not going to share my age, but let's just say this. In '99, Parker Hunter hired me, and I started my covering of software stocks, which meant I only said buy, sell, or hold, right, on a collection of stocks, not actually managing money. But that was October of '99. And by March of '99, things had changed, to say the least. So I've seen some pretty crazy markets. And but that doesn't go away from my message, which is carefully evaluate what you're doing, why you're doing it, what's in your portfolio, and don't get afraid and take an action that's going to damage you.
I want to get back to that in just a moment. Carrie, you wanted to say something?
Yes, I just wanted to add, and this is really important, because when we make statements like don't go to cash, we're assuming that people are investing according to their risk tolerance, that they're not putting short-term money into the market. And as you know, we're not here to give personalized advice to anyone, because if someone does have money invested in the stock market, that they need to pay a bill a month from now, we're not saying that you shouldn't be going to cash in that situation, because we know that with the clients we're dealing with, we wouldn't be investing a person's money into the stock market if they needed that money in a short period of time.
Yeah, I want to get into part of that in just a moment. Frank and Bob, do you have anything you want to add to this part of our discussion?
Certainly.
I think that's
Certainly,
absolutely.
I wouldn't go to cash.
Go ahead,
now
Frank.
the market has gone down. Excuse me, Bob.
No, go.
If you're going to go to cash, you got to do it when everything looks wonderful, because that'll probably end too. And if you're going to buy, you ought to buy when you're most frightened, and that may be now, that may be a few weeks from now. It's hard to say at this point.
The part I would append to that is you should never go to cash, provided, as we all said, and Carrie said it very well, you apportion your money. So if you know you're going to need something in the next year to 3 years, you don't put it in the markets. You put it aside and you allocate it for what you need, so that you have the courage to stay through a downturn with a well-conceived portfolio. So that would be a critical piece before you even begin to invest.
All right. I want to get into that in just a second here, but I'm going to ask each of you. I know you're not prognosticators, but let me ask you this. Do you have a feeling that we're close to a bottom, or it may have already come in? Or is that anything we can even begin to try to assess?
Don't try to assess that. Talking about tops and bottoms is chasing fool's gold, honestly. Nobody can do it. Nobody can do it consistently. You're simply setting yourself up. We all know from the data that we see that if you miss the best so many days out of a year, you'll cut your return in half. How can you cut it that closely and think with hubris that we can pick a top, pick a bottom, and not miss some of the best days? It just can't be done. I apologize.
Yep.
It is in times like we're in right now, where it speaks to having a well-diversified portfolio that matches your goals, that matches your risk tolerance. It is really important for people to understand that someone can do something. What happens if Jerome Powell comes out this week when he testifies in front of Congress and says, we may not be raising interest rates at all? We could see this market skyrocket, or we could see it go down. The best cartoon I've ever seen in this industry was back in the late 80s about a gentleman watching TV, and it said the market's going up because the economy looks like it's doing well. And then the market went down because if the economy is doing well, that means that interest rates are going to have to go up. And then the market went back up. You can't really time these things. And when we look at the activity that happened last week in the market, we actually had a market that was up last week. Mm-hmm. And the reason, and Frank alluded to it earlier, is that if energy prices are going to continue to go up, the Fed may not need to raise rates as much as they thought.
So you've gotten off the idea that Jerome Powell promised us 4 interest rate rises?
No, I'm still very upset about
That's the point. You cannot react to things you think you heard. And even if you did hear them correctly, you can't react that way. It's intelligent portfolio construction is the answer.
I can almost promise you Jerome Powell will not say anything as definitive as what Carrie just explained. He is not going to say, I'm not going to, or I am going to.
But he will say some obscure word that all of us will micro-analyze and come up with our own thesis. And, there you have it.
Well, this was not one of the topics I wanted to get into, but since you guys have all brought this up, what do you listen to? And then how do you make a determination as to how much weight to press on, to put on the war, interest rates, inflation? Just the 3 things right there.
Fundamental facts. What is inflation? What are the motivations toward higher or lower inflation? What are earnings for the companies and the entities that we own? Those are the things we can map out, and we can make decisions on that. But it all washes within the structure of an intelligently, I'll say it again, asset allocated intelligently selected securities within our portfolio. All of the winds blowing this direction, that direction. If we look at short-term volatility, it's going to look like this, day to day, all right, week to week. If we look at month to month, it's going to look like this. If we look at year to year, it's going to look like this. That's what we're striving through is to draw a trend line through that longer term movement, not to try and catch this kind of stuff because it can't be done.
Yeah, to answer your question.
Go ahead.
Go ahead, Frank.
Please, Carrie.
I was just going to say, to answer your question, it really is what Bob just said. It's about fundamentals and it's about data. And for us as advisors with other people entrusting their money with us, we have to understand what the landscape for volatility looks like. Today is a great example. We had a Chicago PMI number that came out that was the lowest we've seen since 2020, which is an indication that growth is slowing. So we as advisors take the facts, which is the economic data that comes out, and we formulate our thesis around that. It's not about what the talking heads on CNBC say. So when we assess this with clients, you know, what may be a buying opportunity for one client? If I have a client that's an aggressive investor, this may be a great buying opportunity. But for that person that is extremely conservative and doesn't want to see a lot of volatility, this may not be a buying opportunity.
Stacy, when I talk to a young person and talk to them about investing their money, one of the first questions I ask them is if they believe the world economy will continue to grow. If they answer no, I tell them to spend their money. If they answer yes, I say, then you should invest your money because you have forever, as Kim likes to say, to experience, to live the roller coaster ride and achieve the profits that undoubtedly will happen over time, provided the world economy continues to grow. So a lot of impoverished people out there whose standards of living will be elevated over time.
Frank, your comment, I think prompts a bit of very important advice. Oftentimes people will say, I'm suspending contributing to my 401k plan, my contributory retirement plan, because things are unsettled now and things have gone down. I'll wait until it calms down. That's exactly the wrong thing to do. By continuing to invest in one's retirement plan through all market periods, you follow that trend line I talked about. You, in effect, dollar cost average into good positions. And you will follow, as Frank said, if you assume that that the economy will continue to be sound over time, you'll reap the benefits of that. There are no guarantees, but it's the highest probability way.
So I have a different perspective than everyone else. And it's likely because my role is to put money to work. I am less of an advisor, more of a portfolio manager. So my answer is this: I read everything, I listen to everything that I can to see what consensus is. And that is the great body of investors that make up professionals on Wall Street. But then I'm also always looking at anomalies. I think this comes from my days as a software engineer, where I specialized in mathematical modeling and artificial intelligence. And the thing that I do going through life, whether I'm employed as a portfolio manager or as a software engineer, I'm always looking for things that disrupt what I think the world is, right? The set of facts that I have. So for example, in 2007, I went on my yearly vacation with my family to the same place that we always went, Outer Banks. And even though theoretically the consensus was that we were just having a great economic time, there were very few people there. And we go there the same week, right? So that let alarm bells go off in my head that something was amiss in the economy. Yesterday, when I did all of my errands at various stores, I think it's the good weather. I think it's a sunny day in Pittsburgh, which is unbelievably rare, as we all know. But I also think people still must have money because parking lots were full, stores were full. There was some holes in the shelves, right, where not all products were there. But it feels different than it did a year ago or 2 years ago when we were in the depths of COVID. I saw a lot of people out spending money, and I think that is a good sign that I wouldn't say all's right with the world, but we're pointed in a positive direction, at least here in the US. Now, what I do with that as a portfolio manager, that's a longer discussion. But I think just being aware of the economic facts that you can see in front of you, it's really important.
So in other words, basically what you're saying is follow the herd until you see that something might make that herd change course. And you're trying to see it before the herd does.
Exactly. I mean, that's kind of like what I do, right? And then it's hard. It's really hard to go away from the herd, right?
Yep.
To sell when everybody else is buying and to buy when everybody else is selling. But that's what you do.
Right. You kind of touched on this, and I want to spend a little bit of time on this. What difference does a person's age make in investing? Frank, I'm going to start with you. Because you kind of said if it's a young person, you ask a certain question, but what difference does age make?
Age certainly has a factor. There's a factor in investing. Carrie talked earlier about when you taking the money you know you're going to need and setting it aside if it's a short-term need. It's absolutely the right thing to do. People say, well, when am I going to need the money? No one can answer that question, because even in retirement, you don't take all the money and put it in your pocket. You just take pieces of it as you need it, or as IRS makes you take it if it's a qualified plan. So age matters because as you age, you have less time to deal with the fluctuations going forward. You don't have the time that may be necessary to recover. If you look at the markets that Bob was talking about earlier in the 70s, market was basically flat in the 70s, volatile but flat. In the 80s and 90s, it went up from 2000 until maybe 2014. It was flat again. Now it's been rising. And if you have to exit with meaningful amounts of money, as you would in retirement, in the flat periods, and you never know when they're going to come. They just show up. And you probably don't even know they're there until you're halfway through it. But this matters. Whereas if you're 30 years old, none of that matters. I mean, it matters to your mind psychologically, but it doesn't really matter because over time, you'll be fine.
Carrie.
Add more when you feel uncomfortable.
All right. Thanks, Frank. Carrie.
Well, I kind of look at it differently. I don't think age matters at all. I think what matters is what a person's goals are, what their needs are, and what their risk tolerance is. So no joke, last night I had a dinner party and there was a 35-year-old at the table stressed out because futures were down 800 and he was worried about his 401k. Now, we know that money he's not going to be able to access or shouldn't access until he's retired, but yet he's so wrapped up. That's an opportunity to educate a young person. But if a young person is going to go to cash at the wrong time, then they shouldn't be invested in stocks. The other thing that we see, and we see it a lot, I'm sure that other people here around the table see this, we'll see elderly people come to us with 100% of their money in stocks with very low basis. They don't need the money. They're going to pass it to their kids. The worst advice we could give them is to sell, pay income taxes when their heirs would actually get a step up in that basis when they pass away. So it really does come down to what the cash flow needs are and what the risk tolerance is.
Bob. Your mic is off again.
I agree completely with Carrie, and I'll say it maybe in a phrase. Age is immaterial. The time period until your objective is what's important. As Carrie said, an 80-year-old can be investing for his or her grandchildren, or great-grandchildren. So, and you could be 100% in stocks if in fact that was the risk tolerance level that person could handle because they're investing for the next 30 or 40 years. So it's objective and time until objective. And then close second is what's my risk tolerance level? Will I panic out and think I can't handle the pain if the market goes down 10 or 20%? If that's true, then I better batten down the hatches before it happens.
Kim.
Well, I'm going to agree with Bob and Carrie. Sorry, Frank. You're the odd man out right now. But I do believe why you're investing is the big question. It's not how old you are with respect to what your cash flow needs are. This money is purely to go to the next generation, or maybe even the generation after that. You have to be in the market, and your age is immaterial.
Frank, I'll give you a chance to counter or come back.
They didn't say anything differently than I said. I just was specifically dealing with age, not conditions.
Yeah.
Yeah, like Frank said, I mean, there is a real opportunity for young people generally because they do have more time. And it's an opportunity for those nervous young people to really educate them about markets.
Absolutely.
I agree with that. When I was pursuing my MBA in the evening and being a daytime software engineer, I realized how many of my coworkers, when we'd talk about what we're investing in our 401ks, they were either in cash or in bonds, which is insanity, right? They're like 30 or 40 years old, and they didn't understand what their real risk tolerance is. And I think that people really have to think about that long and hard and really understand what their risk tolerance is. These were people that didn't pay attention to the market, but for whatever reason, did not select equities or did not have enough equities, in my opinion. So I think that's a lesson for retail investors out there.
All right. I want to thank all of you. It's been a great discussion today so far. Now, it is time to check in with Kim and find out her latest stock suggestion. And before we hear from Kim, I want to stress once again, under the rules and regulations of the SEC, Carrie, Frank, and Bob are not allowed to state publicly any stock picks, and that anything that Kim touts is her suggestion and only hers. Having said that, Kim, I want to say this, that you've made 8 active stock selections so far, and you are standing at 63% winners versus losers. As of the close on Friday, 5 of your selections are higher. The first stock you chose, by the way, was a big winner. And I say was a big winner because, as you said would happen, Xilinx was bought by AMD. Now, when that deal closed, Xilinx was up more than 25% from when you recommended it. One final note on that stock. Since it was bought by AMD, if you own Xilinx, you are now an owner of AMD stock and probably in pretty good position. You're shaking your head, yes, I think you agree. But for our purposes, for the around the table portfolio, I'm going to treat it as a stock that we closed out on the day that it was finally ended on its own. So having said that, which stock are you going to pick this week, Kim?
Sure, and I'll do my own little caveat here. This is for informational purposes only. I am not recommending this. You need to make your own decision with your own advisor. So that being said, I'm sticking with AMD. One of the big reasons why I purchased Xilinx, why I continued to purchase Xilinx, is I thought that the Xilinx AMD merger would be beneficial to both parties. A lot of the times when a company gets bought by another company, we've got somebody that is not coming out so great on this deal. But I really think that putting these two companies together is bringing AMD into a real position of strength where it has these more exotic chips, which 5G generates demand for. So AMD is my pick. And I love that it competes with Intel. And I think having a good competitor will always make another company better. So we have two companies that have good competition, and I like AMD today.
All right, AMD is Kim's stock pick for this week. Carrie, Frank, and Bob, I again want to thank you for joining us. And also I want to thank all of you for joining us. And I hope that you are with us again for the next edition of Around the Table with Stacy Smith. Thanks for watching.